are now live with your audience.
Thank you very much. Good morning and welcome to Wellington's Investor Conference Call. Today we'll review our release of last week to shareholders in the NZX for the 6 months ended June 2019 and provide you with the opportunity to ask questions of Greg and myself. I'm Howard Milliner, Wellington's CFO. I'll start with the usual warnings. We'll be making some forward-looking statements on this call today, and these are predictive in nature. They're subject to a number of risks and uncertainties relating to Wellington, its operations, and the market in which it competes. Some things are beyond the control of Wellington, and actual results and conditions may differ materially from those expressed or implied by such forward-looking statements. The Wellington team is pleased to have delivered a bottom-line profit for the 6 months on the back of further revenue growth and margin improvement. Revenue for the 6 months ended 30 June 19 was $33.3 million, up 19% on the same period last year, $15.8 million for the first quarter, $17.5 million for the second quarter. Revenue included $416,000 for data services compared to $184,000 for H1 2018 and $590,000 for the full 2018 year. The company recognises revenue in its income statement over the contract period, currently ranging from 2 to 10 years depending on the customer agreement. The amount invoiced for data and IPX services in the 6 months was $1.7 million, up from $1 million for H1 2018. There is currently $3.8 million carried on the balance sheet at 30 June 2019 to take to income over future periods. 88% of revenue came from the Americas. Last year it was 86%. In regions outside of the Americas, revenue was flat compared to the same period in 2018. Gross margin increased slightly from 24.7% to 25.8%. Product costs were generally lower than for the same period last year. However, pricing for legacy motor products was reduced to certain high-volume customers to maintain competitiveness. The component supply issue experienced last year is no longer an issue, although there were premiums paid last year still flowing into cost of goods sold in the H1 2019 result. We have made the decision to cease manufacture of electronic circuit boards for EC motors in Malaysia. We're concentrating all our manufacturing in Vietnam whilst maintaining a smaller presence in China for Chinese customers. All our new motor and IoT products are manufactured in Vietnam by East West. Operating expenses increased from $5.8 million in the first half to $6.1 million in 2019. This is after recognising the capitalisation of development time. In cash terms, operating expenses increased from 6.5 to 7.5 due to investment in new sales and marketing skills, IoT software development, and to increase product development capacity generally. We have increased our team by 13 people over the last 12 months, and we expect to add more people in the second half and into 2020 to keep pace with customer demand. EBITDA was a profit of $2.45 million, which is double that achieved for the comparable period in 2018 and the same as that achieved for all of 2018. EBIT was a profit of $1.27 million and the pre-tax result was a profit of $0.8. Interest cost was $0.5, of which $0.3 was interest payable to Onimeg Investments, Smart Shares and Meta Capital. The Smart Shares loan was repaid in March. The Onimeg Investments loan is due for repayment this month, and Meta Capital is due in March 2020. Cash at 30 June 2019 was $1.8 million compared to $0.9 at balance date 31 December 2018. Operating cash flows amounted to $1.1, lower than for 2018 due to customers taking extended payment terms to match the terms their brand customers are demanding. The company is maintaining its previous revenue guidance. Revenue for 2019 is expected to be at similar levels to 2018, although this masks a very significant shift away from older legacy motor products towards the new ECR2 motor platform and to IoT hardware and services. Legacy motor revenue is forecast to be around $8.7 million US this year. It was 5.2 in H1 2018. Is forecast to be around 8.7 compared to 14.3 million US last year, so a decline of approximately 39% year over year. ECR2 and IoT revenues are expected to increase over the next 18 months to offset this decline. Previous earnings guidance was for EBITDA to be higher than 2.5 recorded for 2018. We've narrowed this guidance now to a 2019 EBITDA of around $3 million. Greg will talk shortly about the company's growth initiatives. Generally, we are planning to expand our product and services portfolio faster, support new customer opportunities, and enter new markets with IoT solutions. Due to these opportunities, Wellington is accelerating its investment and assessing both resource and funding requirements. Future investment is likely to require resources to accelerate sales growth, to broaden development capability, and to expand the IoT product roadmap. This growth investment need, coupled with upcoming debt maturities, means the company will explore all funding options available to ensure it maintains the capability to continue delivering strong growth and improving financial performance. At this point, I'll hand the call over to Greg. I'm happy to take questions after Greg has presented.
Thanks, Howard. Hi, everyone. Our strategy continues to be focused on investing in and growing the IoT business with large food and beverage customers, accessing new markets with our IoT and digital marketing solutions, and developing customers for our ECR2 motor platform. Our sales initiatives are developed to find adjacent markets also for our IoT and EC motor products, and these have resulted in more new customer wins aided by the accelerating adoption of IoT solutions. We're continuing to grow and learn as a service provider in the IoT space for food and beverage, with around 40% of sales in 2019 planned to come from that IoT market. We're getting close to 1 million IoT devices with data services sold. Those devices connect point-of-sale refrigeration equipment for the world's largest brands to the cloud and provide fleet management and proximity marketing tools to help them improve their business. We're continually developing new opportunities in this IoT space, the largest one being where we will develop new IoT hardware and data services for one of the largest manufacturers of commercial coolers. While this new opportunity is not formally finalized, so some risk remains, Wellington has been verbally advised it has been awarded this new business. This business will require the development of a new Connect SCS device, a customized data platform for the customer, and software apps to support the customer's markets. Program revenues would likely start later in 2020 with annual run rate volumes of around 100,000. The company will continue to focus its strategy and its investments on developing projects just like this. We will also explore new adjacent markets for our IoT products, such as beer, ice cream, food service refrigeration, and in the IPX digital marketing area, exploring new facilities to connect to, such as sports stadiums and event centres. We're very clear on what will determine where we invest over the coming years, and we'll continue to work on exciting new products and market developments. Our roadmap includes things like new connected IoT hardware to broaden the types of markets we can access. This could include new IoT wireless products with cellular-based technology such as 5G and Sigfox. It could also include new software functionality, including upgraded dashboards for our customers, new digital marketing services, and API and SDK development for interfacing with customer IT platforms, in addition to new software apps to allow our customers to interface with their retailers and their consumers. On the EC motor front, we're working on the expansion of our successful ECR2 platform with a product called ECR2 Plus, a higher-powered motor planned for release in first quarter next year, and this will provide airflow solutions to our cooler customers for their high-power applications. So let me close with just a few comments on our outlook for this year and a bit of color on 2020. We are seeing a sharper than expected drop-off in our legacy motor business, and this is providing a short to medium-term revenue headwind. However, this will eventually be replaced by our broadening and growing IoT and ECR2 customer opportunities. Ultimately, the low-end cooler and low-end motor business is not the segment we rely on for growth and profits. That said, we remain opportunistic and will compete where we can in that low-end space. We are also watching the global macroeconomic situation and various trade challenges quite closely. We're actually taking action on this front, as can be seen by the diversion of many of our products previously manufactured in China or Malaysia to our partner East West Vietnam factory. We believe we have not yet seen a serious drop-off in orders as a result of the global situation. However, seasonal revenue volatility is expected to continue through the rest of this year and into the first half of next year. We are on track to our profit goals in 2019, and as Howard said, we're really pleased with our first ever interim profit, delivered as a result of our growing new business areas. Our team is focused on increasing value for our shareholders over the long term, and accordingly we're in a strategic mode where our priority is investing in IoT growth, investing profits in new IoT revenue opportunities, hiring new sales and technical skills, and entering new markets. As we said at the beginning of this year, this strategy may temper our profit journey in the short term, but it will also ensure we achieve the company's Vision 2023, which is for revenue of around $100 million and gross margins significantly higher as a result of our new products and entering new markets. We continue to think we're an interesting and developing tech company. We're trading at less than 1 times revenue with a clear expansionary vision in the exciting IoT space, which we only entered about 4 years ago. We have a startup business dedicated to digital proximity-based marketing. We're expanding EBITDAs every year for the last 4 years, and we've got a growing list of global food and beverage brands as customers. So in 2020, we'll be continuing to launch a bunch of new products ranging from our new ECR2 Plus motor to our new Connect SCS product for our new IoT project, a new SCS product for retrofit, and the cellular-based product I talked about earlier. These products and many others that we are researching now will help us continue to deliver ongoing financial improvements for our shareholders. Thanks, everyone. Thanks, operator, and we'll go to questions now.
Thank you. If you would like to ask a question, please signal by pressing *1 on your telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press *1 to ask a question. And we'll pause for just a moment to allow everyone an opportunity to signal for questions. Again, press *1 to ask a question. And we'll go to our first question from Roger Armstrong, private investor.
Hi, Roger.
Hi, Greg. Can you tell us a little bit more about this new product for your customer in America? What will it achieve that your existing suite of products doesn't currently achieve?
Good question, Roger. So I would compare the new customer in the Americas to a customer we announced earlier this year in New Zealand, the Scope customer out of Christchurch, where we started selling IoT solutions and data services to Scope in what's called our OEM solution. Now, this customer in the Americas is a much larger version of that type of relationship, but it's also much larger in scale, and they have different types of customers who require different functionality in the hardware. So to enable the cooler to utilize the connectivity differently. They also require different cost points in the hardware. So the new hardware we will develop will be, if you imagine we've got 3 types of product, good, better, best. The SCS we're in the market now is the best product. It's the high-end product. We need to expand that range to have the kind of low-end and the mid-range hardware solution, and that's what we're doing by bringing this new product to market for this new customer. On the software front, they have different data services requirements and the need for software apps on their mobile devices that their sales team and their technicians and their retailers use so they can fully leverage the power of connectivity and access a whole bunch of tools that we'll develop for them to manage their cooler fleet. And those tend to be different by customer. Roger, Scope would have different apps that we would develop, as would these new customers, based on the markets they're in and the products that they need to sell through their retail outlets.
Okay, thanks for that.
Did that answer your question, Roger? Okay, good.
Yeah. Thank you.
No problem.
And again, press star 1 to ask a question. We'll go next to Matthew Lynch with Circata Limited.
Good morning, gentlemen. Thanks
Hi,
for your clear interim report. Just wanted to find out about the protection of your intellectual property when you're dealing with large customers. That is, if, for example, after a number of years under contract, there's a failure of that customer relationship, who keeps the intellectual property arising from the contracts?
Thanks, Matt. Good question. It absolutely depends on the agreement we have with the customer. What we rely on, particularly in the software space, is trade secrets and know-how. It can be tough sometimes to get patents or actual formal IP in that space. So you rely on trade secrets and really locking down the secret source in the software. And in some agreements with customers, we may collaborate on an app and agree to bring in separately that know-how and retain ownership of that know-how. But we also may agree with some customers to collaborate and share the ownership of technology jointly with them. That's possible as well. So where there is technology sharing, that's locked up in commercial agreements. To date, we haven't had a lot of agreements where we've actually given away the secret source to any customers. They basically use an app and they access the tools that we develop, and they get an interface to their system. Their systems are separate to our systems. When I talk about SDKs or APIs, those are interface software systems that we develop, Matt, that allow our system to interface with their system, but they remain separate in an enterprise sense. So we protect them both through the way we develop the software, but also through commercial agreement if needed, Matt.
Right. Thank you. And could I ask a further question just about the stress placed on you vis-a-vis payment streams and the pushing out of payment terms? Is there any change likely in your planning to move to customers who don't put the pressure on you in terms of funding, you who are quite a small company, in terms of funding sales?
I'll answer that one.
Okay, go, Howard.
So I'll answer. I mean, it would be lovely to be able to prioritise customers on shorter terms and longer, but it's really, especially in the Americas, it's almost standard practice to require at least 90-day terms, and in some cases 120, 150 days. And the pressure is coming not from our customers but from the big brands. So it's it's all the big bottlers, Cokes and the Pepsis and the ABIs of this world that are requiring extended terms from their fridge suppliers, and the fridge suppliers are trying to back-to-back their terms with us, as indeed we try and back-to-back our terms with our suppliers. So we push back continually, but there's not much else we can do really, other than we're keeping it to around 90 days. Some customers offer us funding, including the big ones. So that is quite attractive. I think we're averaging around about between 65 and 70 days payment terms on our customers, and we're taking about 90 on our suppliers. But I'd love to be able to shorten it up, but that's proving very difficult.
I would add, Matt,
it's difficult to do that in pricing.
Carry on, sorry.
You can't price differentiate a little bit. It seems a very tough thing to ask a small company to be a bank.
Yes, in some cases we can offer, and we actually do with a large motor customer, price incentives to accelerate payments terms, and we've had a little bit of success with that when we get into business that is outside of those large food and beverage brands, Matt. But the industry norm in that FMCG space, particularly in North America with those large F&B brands, is extending payment terms. And in many cases, I know in New Zealand, I think we're getting our first Costco store in New Zealand. But those kinds of retailers, those large North American fast-moving retailers, they have some very onerous payment terms and product return terms. And so you have to try and bring products to them that they need versus don't need, and then you might be able to get some flexibility, as Howard said, in funding the receivable, which we do with our largest customers, that's really where the opportunity exists. What they do is they push the payment terms out to 180 days, but they'll fund it for you. So that's the way they work. And we've availed ourselves of those opportunities where they exist. The only other thing I'd say as I think about it, the software business allows us to differentiate ourselves a little bit, because on the software side of things, when we're selling data services, we're not, we're selling a lot of those services in advance with multi-year contracts. And so the long payment cycles tend to be on the hardware, and on the software business, there's a lot more opportunity to get different long-term agreements that improve that payment cycle.
Right. Thank you very
Thanks,
much.
Matt.
Again, press star 1 to ask a question. And no one else is queuing for a question at this time. So I hand the call back over to our speakers for any additional or closing remarks.
No one else.
I do apologize.
Okay.
I do apologize. We did get another questioner to queue up. Mike Daniel, private investor.
Hello, Mike.
Hi. How are your investigations going on with regard to your funding requirements?
They've really only just started, Mike. I mean, the debt maturities that we've got coming due, we're pretty comfortable we can cover those out of cash flow. But as we've said in our comments and in our interim report, we've got these large new projects that we're working on, the big one in particular that we're developing these new products around, and several others in the hoppers that we want to go after. So we're just trying to figure out what we need to do going through the next 12 months to put some real muscle behind these and really accelerate and broaden that product portfolio. For us, it's all about top line right now. Once you get into these customers with an IoT solution, you stay there. You stay there for a very long time. So if we can't kind of proliferate our product portfolio and win these new projects, someone else will win them and we won't get the chance for another 5 to 10 years. So, winning the products, growing top line fast, getting the products to these new customer projects. So how we fund that over the next 12 months, we've just really started to figure out, to be honest, in the last few weeks when we started talking about it.
Yeah, and so the banks, now that you're making a profit, you would think that's the sort of carrot they've held out over the many, many years that they haven't funded you. Now there's a profit there. Is there any chance that they might give you some sort of an all-encompassing facility so you can get away from this high-interest regime, which is really crippling for everybody?
Indeed. We're supported right now by the BNZ, and they've been actually very good. They started supporting us this year, and they improved their support slightly this year, and they're kind of, I think we've started the right way with them, so I'd be optimistic that over the long term they'll keep supporting us, and that support will get better and better. Is that enough for what we want to do? Not sure yet. We certainly want to get rid of the high interest debt, that's for sure. And I'd love to be able to do it through the trading bank debt more and more, but we'll see how that pans out over the next few months.
Okay. I think in the meantime, until that's resolved, the indications could be and a cash issue for shareholders, and so that'll hang over the market until that's resolved, I would think.
Well, that's your words, Mike. I think, like we say, we do have a bunch of options sitting in front of us, and we're just trying to figure out what are the right ones for the company and for shareholders, of course, because we don't want to take our foot off the pedal.
Absolutely. Yeah.
Thanks, Mike.
Okay.
And again, press star 1 to
Anyone
ask
else?
a question. And no one else is queuing for a question, so I hand the call back over to our speakers for any additional or closing remarks.
Okay, thanks everyone for joining the call. we enjoyed delivering our first half-year profit, and we think going forward, if we can keep growing and keep developing these products, there will be more of those to come. But again, it's profits are really, really important, but I think what's more important for the company right now is accelerating that top line and winning as many of these large projects as we can, because that will also bring the profits that we all need. So, and that means we can make a difference for these customers out there that are trying to get better and better themselves in an uncertain world. So if we can help them do that, then we will be successful as well. So thanks for listening, and I'm actually in town next week for 10 days, so I'm around town if anyone wants to catch up with me in person. Thanks again. Have a good day.
That does conclude today's conference. We thank you for your participation.